Hey, what's up? Welcome back to the channel. I'm Chris. As usual, super happy to see you here. Today, we're gonna deep dive into Disney. They just reported their fiscal year 2022 results, so there's a lot to unpack. So with no further ado, let's jump right into it. So Disney already had a terrible last year, but it just got worse yesterday when they reported their earnings. Their stock crashed as much as 11% in after-hour trading, but then it settled at roughly negative 7%, negative 6.8%. So it has another really bad day coming ahead today. So before the day opens, I want to keep you guys updated on what happens. So the first thing that we're going to do is we're going to look into our report and we're going to try to understand the business, what exactly happens, why the reports are so bad, why the market reacted to it so bad, and then afterwards I'm going to give you my personal opinion to what to do next. So the stock tanked mainly because Disney actually missed their earnings and their revenue both, and additionally to that they also forecast much slower growth going forward, and of course for investors that is really bad news. It's bad to see, and the stock due to that collapsed 11% in the post-market trading. Looking into their official report, we can actually see that Disney grew very good over the last year. We actually had growth of 23% compared to last year. So year-over-year growth is in fact very good. There is not much to complain about. So, the company is not performing badly. There are just a few things that we're going to look into, and that explains why investors are being so nervous about it at the moment. One of those things is actually earnings. So we can see that diluted earnings per share came in at 30 cents per share compared to 37 cents per share the prior year. So what happened is that earnings decreased, so we're not as profitable anymore as we were last year. And that came, I think, to a big surprise for most of investors, because last year we were still kind of a little bit in this whole, pandemic thingy, and parks couldn't really open and there was a lot of trouble going on. And this year actually we've sort of been out of that, but still earnings are actually decreasing, which of course is a bad sign. Now a lot of that earning decrease is coming from direct to consumer services, so their Disney Plus. Their parks have not performed very bad, but we'll look into that a little bit later. But year over year we can see that earnings is still increasing. So we increased to $3.53 per share from $2.29 per share the prior year. So those are yearly number, and previously the 30 cents from 37 cents were quarterly number. So quarterly actually we had a bit of a decrease, but yearly, as we mentioned at the beginning of the video, we're still doing fine, we're still growing. There are some other good news also in the report. We can see as example that subscribers for Disney Plus and Hulu ESPN have increased to 235 million users. So that is an increase of almost 60 million subscribers in 1 year. That is absolute bogus growth. It's crazy. We have become, with Disney, actually the biggest streaming provider in the world right now. So Netflix doesn't have that many subscribers. Also any HBO or whatever, they can get close to what Disney is doing here at the moment. So it's really fantastic. That's really good growth. Those 235 million subscribers are broken down into Disney Plus subscribers, which we have 164 million compared to last year of 118 million. So really good growth. 40% growth in a year in subscriber. It's ridiculous. Very good. And then we've got the Hulu subscribers of 47 million compared to 43 million. So there's a little bit of a slower growth, but still 8% is really good. So in total we got that insane growth. But what's a bit of a problem here is that their revenue per subscriber is actually decreasing, and it's decreasing in almost all markets. So we can see in US and Canada we had a decrease of 10%. So from $6.81 average revenue per customer, we're getting down to $6.10. That has to do a little bit from ads. Also, the people are buying more bundles. It's explained in the report. It's just a pity to see, because we have that really strong growth, but it's being diminished a bit by lower revenue per subscriber. On the other hand, Disney parks are growing really, really good. So last year we made roughly $3.5 billion US dollars in revenue in those parks, and then this year we're up, roughly to 5 million US dollars. So we had that really good growth, and of course that has to do with easing of some restrictions and stuff. So globally, more and more people are able to go into the parks again and to enjoy those parks and so on, right? So that's of course mainly the growth from there. We can also see international has increased, right, 55%, which is of course good. But this is a bit skewed because of course the pandemic, right? So the numbers are a little bit off if we compare it to pre-COVID. The numbers are okay, but they still can't really reach that level where we were actually before. So in total, the parks grew from 5.5 billion, 36% up, to 7.5 billion. So we are slowly recovering, but there's still way to go. And investors are probably getting a little bit impatient at the moment that why we can't just get back to pre-pandemic levels. Then, as most of you guys know, another point that is really important for me is free cash flow. And free cash flow has not been doing that well. We can see we're almost down $1 billion from last year. So my thought is that there will be more capex, so more capital expenditure that has to be invested in the parks and in the streaming businesses. So that weighs on free cash flow. $1 billion of cash flow is really not much. The company at the moment is worth roughly 188 billion, 190 billion, somewhere in that area. So 1%, is like 0.5% free cash flow yield. So it's really, really tight. It's really small. And I would like to see that going up, to 2-3%, like a lot of other companies can actually achieve. So looking into the income statement, so a combination of everything we just talked about, we can see that revenue came in at 82 billion US dollar versus 67 billion US dollar. That's really good. Costs and expenses, of course, have also increased, but we can see that income from continuing operations actually has doubled. So from 2.5 to more than 5 billion US dollars. So that is definitely something very nice. So we've got a nice net income of 3.5 billion US dollars. Then of course from here we've got some deductions. So our net income attributable to Walt Disney shareholders is roughly 3.1 billion US dollars versus the 2 billion that we had last year. So that is definitely good. The problem here is more the quarter over quarter growth, right? So we can see that earnings quarter over quarter have really not grown. We're still at 9 cents per share, which is of course a little bit demotivating because in that year a lot should have happened, right? Year over year, it looks much better, from $1.09 to $1.72 of income, right? So that's much better. But again, the problem is really here, the quarter over quarter. Now, going into the earnings have really disappointed. Even though revenue has, been record high, Disney has never had such high revenues like now. Earnings are just disappointing. And that is coming again from Disney Plus and Hulu. So from the streaming services. The cost of streaming services is just too high. Of course, a part of that has to do with the crazy inflation that we're seeing in the US, right? Everything is getting much more expensive. And Disney states that also in their results here. They say they have increased costs, labor costs, design costs. Everything is getting much more expensive for them to produce. Also, they have to start to create more content. So they're really getting into the same problems like Netflix got, over the time. And to sustain growth in that streaming business, they just have to create a lot of stuff, right? And that's really hurting at the moment. We can see that best here. Have a look. So direct to consumer, that's what is their streaming part. And over here for the operating income. So the revenue is up roughly around 8%, right? From 4.5 billion to 4.9 billion US dollars, right? But if we look into the operating income, we see that we lost 630 million last year on streaming. And this year we've more than doubled that, over 100%, right? To 1.5 billion US dollars in loss. So we're losing much more money than revenue we're earning, right? So we've only got more revenue of roughly around 400 million, but we've got over 700 or 800 million more in expenses. And that's a big problem because of course Disney has invested so much and this streaming has become so important. So Disney has to make sure that at some point they're going to start to get, you know, free cash flow positive with streaming. They get like profitable with streaming. They really have to go in that right direction. And the CEO, Bob Chapek, he actually mentioned that they will be able to do that in 2024. So all investors are kind of looking down that road. But he also mentioned that growth from this year onwards is going to be much, much slower than it has been. So Disney is kind of in a difficult position where they don't grow that fast anymore because they already got 230, 240 million subscribers, right? Their parks are up and running. So they're already huge. They won't grow that fast anymore. And at the same time, they're still not profitable. And from a business standpoint, that's really bad. Because what you want to happen is that in your growth phase, it's okay if you're unprofitable, but once that growth kind of flattens out, you want to make sure that you start to get profitable, right? So you can start to pay down debt, you can start to actually, buy back shares, you can start to pay down a dividend and so on, right? So all of that is missing now. Another thing that I believe that every investor in Disney should keep in mind is Disney is not just Disney. It's not just the parks and the streaming. Disney is huge, right? So I found this really, really nice kind of a graph of what belongs to Disney. So have a look at this. I mean, Disney is Marvel, right? Marvel belongs to them with all the Marvel franchise, with Marvel Studio, right? It all belongs to Disney. 21st Century Fox belonged to them, right? With 20th Century Fox, actually, with FX, with Sky, with Hulu, right? With National Geographic's Fox. So it's a huge conglomerate. Look at this. Only the Walt Disney Company, right? So Lucasfilms, Disney itself, right? History Channel, Vice. I mean, so many. The Disney Music Group belongs to them, right? Pixar for the animated movies. I mean, it's just insane what everything belongs to Disney. If you guys want, just pause it here, have a little bit of a look into it if you'd like to. ESPN, of course, for the sports belong to them. I mean, it's just massive. So if you're actually buying Disney, you're buying a piece of all of those small businesses, and all of it together, they just have a crazy moat. It's a really good business. So for me personally, I am invested in Disney. I own roughly around 5 shares, I think, at the moment. My cost basis is a little bit higher, of course, than what it is at the moment. So my cost base is around $107, $108. So I am down a little bit. But I'm telling you, if today the stock drops, another 10, 11%, I'm definitely going to buy another 1 or 2 shares. I think in the long run, and that's also what the CEO is saying, in the long run, Disney will perform very, very good. Now, of course, that's my personal opinion. I'm not a financial advisor. But for me, I think it's a no-brainer to buy a few shares of this company because I don't think it's going to go anywhere. In 10 years, in 20 years, in 30 years, Disney is still going to be there. Who is going to replace them? Right? So I don't think it's going to be a bad investment. So for me personally, I'm definitely going to get into some more shares. I think it's really, really good. But of course, up to everybody owns risk assessment, what they want to do, right? So that's it already for me for today. Thank you very much for tuning in. I hope you enjoyed it. If you did, please subscribe, click that like button.